China is suppressing with the West on paper, drive down the price, and then accumulating it everywhere else around the globe where the price isn't affected by acquisition. So whether it be taking doré or concentrate from the miners directly, which completely disintermediates the market, they can also buy it off of exchanges and on platforms throughout the globe where price isn't determinant upon offtake, as it would be in London or in New York. They're using the suppression of the Western system against us, as we've said over and over and over again. And you can see it very clearly, especially when you see the amount of gold and silver that they are accumulating. Their numbers of gold are off the charts right now. In fact, I think what's coming in is the record numbers that they're reporting. I would argue a large portion of what they have and what they purchase and what they bring in and certainly what they produce is not reported to the IMF. Why would they want to do that any more than we report what's held inside of Fort Knox?
China is executing a calculated strategy to accumulate gold while suppressing Western precious metals prices, according to industry analysts who view this as part of Beijing's broader plan to reduce its reliance on the US dollar and prepare for economic uncertainty. Silver premiums in China remain robust, holding at 4.45% above the LBMA benchmark, roughly $1.69 per ounce, even as more supply makes its way to New York. This tells us something particular. The East and West are no longer competing for silver, they're both accumulating. Andy Schectman, CEO of Miles Franklin Precious Metals, describes China's approach as highly effective, noting how the country utilizes Western price suppression to quietly accumulate reserves. While China reports record imports, Schectman believes the actual totals are much higher, as much of the country's buying and production goes unreported to the IMF, much like how the US keeps its Fort Knox holdings undisclosed. The People's Bank of China has reported gold purchases for 7 consecutive months, adding 1.9 tons in May. This brings China's official gold holdings to 2,296 tons, now accounting for 6.7% of its total foreign exchange reserves, valued at approximately $242 billion. In 2025 alone, the PBOC acquired 16.8 tons of gold, aligning with predictions made by Andy Schectman. Bart Melek of TD Securities explains that China is diversifying its $3.3 trillion in foreign reserves, of which only 6.7% is gold, to protect against the erosion of purchasing power of the US dollar amid concerns about America's $37 trillion debt growing unsustainably quickly. Key motivations include purchasing power preservation, mitigating sanction risk, and adjusting for less trade with the US, as tariffs reduce the need for dollar holdings. Schectman highlights how China allegedly uses paper markets to suppress Western gold and silver prices while accumulating physical metal in regions where purchases don't influence global pricing, allowing acquisition at artificially low prices. This video explores the outlook for silver and gold, focusing on how China is quietly accumulating precious metals through strategic methods. If you value data-driven financial insights, be sure to like and subscribe for weekly updates. Your support helps us continue to deliver valuable content.
If you look at the COMEX delivery numbers, you go back to November, but look at them and they're extraordinary. Someone or some institutions have a very, very strong desire for physical delivery. So far, just through the first 3 days of the August contract, we saw 20,126 contracts stand for delivery. Now, that's just in the first 3 days. That's let's just do the math. 20,126 times 100 ounce bars. So let's do that math here. 20,126 times 100, 2,012,600. Let's just call it times 3,400-ish. That works out to $6,842,840,000 worth of gold in the first 3 days of the delivery contract. Silver, this is not a major delivery month for it. We saw 1,064 contracts worth about just over 5.32 million ounces of silver. Each contract's 5,000 ounces. So again, in platinum, 1,006 contracts. Yes, that's 50,300 ounces. Each contract is 50 ounces. What's really significant, and these are very significant early numbers, especially with gold, seeing huge delivery volume in the month already. Well, this suggests strong demand for physical. And what's really interesting is so far, every contract that has been issued is settling in physical metal. indicating the real demand. And it's like a 1-to-1 ratio. This is significant because you rarely see that happen in COMEX. I've mentioned that to you in years before that, futures contracts are usually closed out before delivery. They're traded for profit or settled in cash. When contracts are stopped, which is what the lingo they use, that means that the physical metal is actually changing hands. Now, in terms of how much is leaving the exchange, a lot. Not all of it, but a lot is actually leaving the exchange. And August is one of the major months for gold, and you typically see higher open interest and delivery volume. But the strong intent to take physical metal where every single contract has been stopped, meaning buyers aren't shutting their positions, they're taking delivery, this is ridiculous. I mean, it's huge. But this is exactly what we've been seeing, the delivery volume and the vault withdrawals, the loadouts it's called. There's been steady outflows, suggesting that loadouts are occurring relative to deliveries more so than ever before. And so I think it's really, really important. It's not a 1-to-1, but it's pretty damn close. And so silver supply, same thing. We're seeing huge deliveries. This isn't a primary delivery month for silver, but still huge delivery, and they're leaving. We're seeing huge inflows into the ETFs. Massive demand for silver, and I think it probably is the most undervalued asset on the planet, but gold is getting the spotlight. Silver's kind of in the shadows. I just think that we've talked a lot about what's going on behind the scenes, where China is quietly stockpiling both gold and silver through unofficial channels, enabling it to purchase silver without affecting the silver spot market. I think that's really where the mystery is, how much silver is being accumulated by countries like China. I think they're making a specific drive to accumulate stuff off exchange, even though we are seeing a lot of deliveries because it's a smaller market. They're trying to keep it, I guess you could say, less apparent to the rest of the world what they're doing. So no, it's amazing the amount of gold that's been delivered in just the first 3 days. But this is what we've been talking about now every month since the beginning of the year, and it's showing no signs of slowing down. In fact, it's showing signs of increasing. And one of the things that I said to you a few weeks ago was the significance of the 11 Asian countries and the 5 Middle Eastern countries that have connected to BRICS Bridge, and how this is something very big. We talked about how Sergei Lavrov, the Russian foreign minister, said, we're opening up the bridge platform, the Enbridge platform, to non-BRICS nations, right? But we focus quite a bit on these Asian countries. And somehow, luckily, I guess maybe I really was onto something, because there was an article that just came out of Forbes where they pointed out that China is now just the 3rd largest trading partner for the United States, and a distant 3rd behind Mexico and Canada. In fact, in the month of May alone, China was less than 6% of U.S. trade, which was the lowest level in over 20 years. And then you look at the Asian countries, which is very interesting. These Asian countries that have signed up to BRICS Bridge, together they have a population twice as large as the United States, over 700 million people. And these are also some of the fastest growing consumer markets in the world, with, their middle class is growing. And this group of countries is now China's largest trading partner by far, way ahead of the European Union and the United States. This is coming out of Forbes. You have China's largest trading bloc, which has 700 million people, which is way more than we have. That is not the largest trading partner that is now connected to the bridge system that allows these banks, central banks, to trade with one another, free from SWIFT interference, in a system that settles in 7 seconds at a 98% reduction in fees. And remember what we talked about last week, the BRICS Pay, which is a B2B or a bank to consumer. It's retail. Well, that's hooked up into this system too. So all of these countries who are now working very, very closely with China, that have a much bigger population, and almost over twice as much as the U.S., some of the fastest growing consumer markets in the world with a rising middle class, is now able to trade BRICS Pay free from any SWIFT interference, and the banks, the central banks, can trade across this rapidly growing consumer market free from SWIFT interference in 7 seconds with a 98% reduction in fees. So the fact that we talked a lot about it is big. The fact that Forbes just said that they are their largest trading partner now, period, tells you just how big it truly is. And so what you can see is the infrastructure that is being set up, right? And now that we see that you can take delivery in gold in Shanghai Exchange in Hong Kong right now, and the second one is being built in Saudi Arabia. Remember before the M Bridge stopped being called M Bridge because of the BIS interference, and now it's just called the Bridge? Who was the fifth partner that signed up as a full member of the bridge technology? It was China, Hong Kong, Thailand, UAE. They developed it with the BIS Innovation Hub. And the fifth member, you remember? Saudi Arabia. They signed up after as a full participant. Well, where's the second vault being built? Oh my God, it's Saudi Arabia. How the hell did that happen? So Saudi Arabia will sell their oil to all of these Asian countries. It'll settle over the bridge network. The West will have no idea because SWIFT can't even see it. Zero idea of how much they're doing. It'll settle in 7 seconds without going through the SWIFT banks. And it will be then, they'll take all of those currencies of the Asian nations, and they will settle in gold, if they wish, at the Shanghai Exchange and take physical possession of it. So this is just the very beginning of what I believe is a new system. And the way they are doing it is ingenious. They're doing it in a way that is non-threatening to Trump because it doesn't have the BRICS name after it. It just has China's name after it. Right now, they're internationalizing their yuan, and they're internationalizing the ability to settle their yuan in gold without converting to dollars. Well, how hard will it be just to insert the unit instead of the yuan? It'll be very easy. And so you are now opening up this trading platform to the oil-producing countries and to China's biggest trading partners in Southeast Asia. And you are opening this up in a way, little by little, that when it is fully operational, will be nearly impossible to overthrow. It's massive news, Dunnigan, and it just keeps getting bigger and bigger and bigger.
The precious metals market is experiencing extraordinary activity as gold and silver reach remarkable price levels while physical demand drains global inventories at unprecedented rates. Gold hit $3,377 per ounce on August 4, 2025, posting a 40% year-to-date gain, while silver touched $37, up 30% for the year. These dramatic moves reflect fundamental structural changes beyond typical investment flows. COMEX silver inventories reached an all-time high of 506.7 million ounces by July's end, but this masks intense physical demand. In 2 days alone, COMEX vaults absorbed 107 tons of silver, 45 tons on Thursday, following 62 tons earlier in the week. This represents more silver than many countries import in a year. Andy Schectman warns of a critical disconnect as retail investors remain heavily leveraged in equities, while insiders are quietly moving into physical metals. Record deliveries on global exchanges totaled $6 billion in the first 3 days of August, following $8 billion in May, rapidly draining supplies. Andy Schectman notes that on COMEX, every contract is now being physically delivered, revealing genuine demand for actual metal rather than paper exposure, a fundamental shift most retail investors haven't recognized. COMEX delivery activity has compelled exchanges to manage shortages actively. March silver deliveries exceeded 15,000 contracts, well above historical norms, compelling continuous inventory restocking to meet unprecedented physical demand. Central banks provided crucial structural support, purchasing 410 tons of gold in the first half of 2025. Investment flows reached historic levels, with gold ETFs attracting $8.3 billion in net inflows year-to-date, including a single-day record of $775.9 million. Silver ETPs saw 95 million ounces of net inflows in H1 2025. Let's get back to the interview.
King Kong on Twitter, who I love, he's amazing, and he's saying, well, China is suppressing with the West on paper to drive down the price and then accumulating it everywhere else around the globe where the price isn't affected by acquisition. So whether it be taking doré or concentrate from the miners directly, which completely disintermediates the market, they can also buy it off of exchanges and on platforms throughout the globe where price isn't determinant upon offtake, as it would be in London or in New York. So they suppress the paper price and then go buy it everywhere through sovereign wealth funds. I wouldn't be surprised if they're buying coins too, and all sorts of things, whatever amount they can get where it doesn't cause the price to move or any attention gleaned upon them. Yeah, I think that's exactly what they're doing, and it's a great model. They're using the suppression of the Western system against us, as we've said over and over and over again. And you can see it very clearly, especially when you see the amount of gold and silver that they are accumulating. Their numbers of gold are off the charts right now. In fact, I think what's coming in is the record numbers that they're reporting. I would argue a large portion of what they have and what they purchase and what they bring in, and certainly what they produce, is not reported to the IMF. Why would they want to do that any more than we report what's held inside of Fort Knox? So margin debt is the total amount of money that an investor would borrow from their brokerage to buy stocks. So if you put in $10,000 of your own money, you can borrow another $10,000 from your broker, and now you control $20,000 worth of stock. But half of that is debt, and there's a certain level where if it goes below that, you have to come up with a margin call to keep that from. It's a speculation. It usually, the higher the margin debt, the more leveraged and dangerous the market is. Margin debt just hit $1.008 trillion, the highest level in history. That's more leverage than at the peak of the dot-com bubble or the 2008 crash. It's the most dangerous signal in the markets right now. And remember what we were saying last week? Ma and Pa have virtually no exposure to commodities as the world's commodity exchanges are being bled dry month over month. The largest deliveries ever. $6 billion in the first 3 days of this month, $8 billion in May, the largest silver delivery ever in May, the largest gold delivery ever in May, and on. Every month we're seeing this, and the public has virtually none. On the other end, the insiders are dumping stocks at record levels. What's his name? From Jeff Bezos, $6 billion worth of stock since June he's sold. Look at Jamie Dimon, look at Warren Buffett, look at Zuckerberg. They're all dumping. The institutionals, the big traders, have been averaging $2 billion a week since June of sales. They're all leaving the equity market, and you have the largest amount of margin debt ever and the largest allocation to stocks by the retail public in an all-time. What could possibly go wrong? The insiders are going heavy in commodities and dumping stocks, as the public has nothing in the way of commodities and is the deepest in not only the stocks, but also margin debt of all time. It's a very, very bad thing. And if you're a conspiratorialist or realize that the line between conspiracy and reality has grown thinner and thinner and thinner, or you just realize that the big money, like the little man rule, is always moving when the other group has no idea. And this is how it always goes. So should we expect, August is typically the worst month of the year for stocks. September is usually a bad one too. But should we expect something? Remember what happens in October. We're at the part of the year where it's typically very
choppy.
Tenuous. Yeah, choppy. So, but at the same time, the biggest money in the world is jumping into gold and silver, and no one knows it. No one understands it. No one sees it. It's a big deal, Dunnigan, and whether you're talking unemployment, inflation, everything is pointing towards craziness coming up. And to me, the real demand for physical metal on COMEX underscores everything, because that's never happened before. When you see every contract stopped, every single one that was posted went to delivery instead of settling in cash. These are things you never see ever. And it's continuing. So I guess only time will tell where this all ends up. But even like our allies are pushing back. India is being threatened if they continue to buy oil from Russia with another tariff from Trump. Well, India said we're not going to stop buying oil from Russia. So, at what point does it piss off our allies so much we keep poking them, where they say, you know what, I'm glad I've set up an infrastructure with these guys. And at what point does Saudi Arabia, who is a full member of the bridge technology and involved in all of these meetings and setting up a Shanghai Metals Exchange in their country, what point do they say, we're done? I mean, this is the little by little. Are they waiting out Trump? I don't know. But you can see this, and we're even aggravating Mexico and Canada and all of these countries that have been on our side. We're putting tariffs on all of the European countries that were supposedly our allies. Maybe they really are trying. I think they are trying to lose the reserve status. They understand it's hollowed out our manufacturing. There's no way back unless we stop being the reserve status, but focus on the legitimacy of our treasury market. That's more important. And I think it's a soft default on the dollar and the lesser of two evils. And everything I'm seeing, whether it be Trump's actions, the market's actions, the gold inflows, the central bank purchases, the repatriations, everything is pointing to this. Everything. So yeah, it's, I think the worst possible place you can be right now is really, truly is a large dollar holding. And we haven't even talked for a while about the banks. We don't need to today, but keeping your money in a banking system where if things go haywire, you're an unsecured general creditor in a currency that's lost 11% this year, and just accelerating the trend that we've seen since the forever, since the Fed came up, and since 71, we've lost 90%. I don't know. I just think it's time to realize that we're there. We are there right now. With this new stablecoin bill, you could argue it is a new monetary system that is happening, going from synthetic demand, from organic demand to synthetic demand, and that's where it all starts. So loss of confidence, loss of trust, loss of value. Now's the time. I know we're getting to the end here. About David Rogers' Web, The Great Taking. I think I'm right about this, so I'm not positive, but I'm about 95% certain about this. Okay, his whole premise is that you don't own this stuff and it can get taken from you because it gets pledged, your securities get pledged to other entities. And it has to do with margin, where every account you have is margined unless you specifically tell the brokerage, do not ever put me on margin. In other words, they can take your securities and lend them out to others on margin. And when that happens, if they get that margin call and default on it, those stocks that were margined out, which you didn't even know you lent out, they go to the company that leveraged or that lent them out. They have first right over you do. I mean, that's pretty much his whole thing. And I guarantee you 99% of the people who own stocks in this country have no idea that you have to physically and expressly tell custodian or the brokerage, do not ever margin anything on. You have to fill out some paperwork. Otherwise, they are marginable, and that's how you lose them in that, the system where it just collapses.
As margin debt hits record highs and insiders quietly exit equities in favor of physical commodities, a clear shift is underway. Massive gold and silver deliveries, unprecedented COMEX activity, and strategic moves by global players signal growing distrust in the current financial system. Gold and silver are emerging as safe haven assets amid growing uncertainty, with strong demand underscoring their role in preserving wealth. While the public remains overexposed to stocks and unaware of these trends, the most significant capital is positioning for a new monetary landscape, one anchored in tangible assets like gold and silver rather than paper promises. Stay tuned for more. If you value real, data-backed insights into the evolving financial system, be sure to like and subscribe so you never miss a weekly update. Thank you for your support, and I hope you enjoy the video.